Welcome to this explainer. Today, we're going to unravel the complex and, let's be honest, often misunderstood world of partnership taxes. And we're going to do it using the story of a custom sheet-making business called Color Comfort Sheets. We're going to take all that theoretical textbook knowledge and apply it directly to a real-world scenario, so you can see exactly how the math and the laws actually play out.
So here is the million-dollar question that pretty much every aspiring entrepreneur faces when structuring a new enterprise. When you start a business with other people, you obviously want to grow your wealth, not just hand a huge chunk of it over to the IRS twice, right? You don't want to get taxed once at the corporate level and then again on your personal tax return. Well, the solution to avoiding that brutal double taxation often lies in the partnership structure. Here's our roadmap for Color Comfort Sheets today. We're going to cover 1. The flow-through advantage, 2. Forming the partnership, 3. Setting the tax clock, 4. Operating and reporting, 5. Adjusting your tax basis, and finally, 6. Overcoming loss limitations.
All right, kicking things off with Section 1, the flow-through advantage. So, as we all know, unlike your standard C corporations, partnerships are flow-through entities. This means the profits of the business are not taxed at the entity level. Instead, the income and the resulting tax liability literally flows right through to the partners. In our case study, that means our founders Nicole and Sarah, along with their corporate investor Chan's Inc., are taxed only once when the profits finally reach their individual or corporate tax returns. It's a highly efficient system, but man, it requires some meticulous accounting.
Moving right along to Section 2, forming the partnership.
Now, this is where things get kind of fun because you can actually contribute different types of assets to get your slice of the business pie. When our founders set up their LLC, they didn't just get generic stock. They received a bundle of economic rights, and these are broken down into two very distinct categories: capital interests and profits interests. A capital interest gives you a right to the net assets if the business shuts down and liquidates today. A profits interest, on the other hand, only gives you a right to a share of future profits or losses. And as we'll see, the IRS treats these two types of interests very differently. Let's put some numbers to this and look at Nicole's initial outside basis. This concept is incredibly important because it essentially tracks her tax investment in the partnership. Let's break it down. Nicole contributed $10,000 in cash, plus a piece of land with a tax basis of $20,000. But that land had a $40,000 non-recourse mortgage on it, which the partnership assumed. So she actually gets relieved of that $40,000 liability, which lowers her basis. But then she also gets allocated a portion of the partnership's total debt, including a new bank loan, bumping her basis back up by $26,666. The net result of all that? Her starting tax basis is $36,666. You literally have to track every single dollar of debt to get this right. And to get that basis math right, we absolutely must distinguish between recourse debt and non-recourse debt. Recourse debt basically means someone is personally on the hook if things go sideways. In our case study, Sarah and our corporate partner Chan's Inc. personally guaranteed a bank loan, making it recourse to them. Non-recourse debt, conversely, is usually just secured by a piece of property, like the mortgage on Nicole's land. The lender can only take the land, not the partner's personal assets, because banks, they always ensure they have a way to get their money back. The type of debt completely dictates which partner gets to claim it in their tax basis.
So here's a crucial point. What happens when someone doesn't toss in cash or property, but instead contributes their time and expertise? Well, Sarah contributes marketing services to Color Comfort Sheets and receives a $20,000 capital interest in return. Because a capital interest has immediate liquidation value, boom, this triggers immediate tax consequences. Sarah actually has to recognize $20,000 of ordinary income on her personal taxes right now. Conversely, the partnership gets a $20,000 deduction, which is then allocated to the other partners who essentially gave up a piece of their capital to pay Sarah.
Okay, Section 3, setting the tax clock.
Because partners might have completely different individual tax years, like humans are usually calendar year taxpayers, but corporations like Chan's Inc. might have a June 30th year end. The IRS uses this specific hierarchy to prevent owners from unfairly delaying their tax bills. You don't just get to pick your year end out of a hat. It turns out you have to test for a majority interest taxable year, then the principal partner's taxable year, and finally, the year that provides the least aggregate deferral.
The whole goal of that strict flowchart is to prevent aggregate deferral. Just look at this timeline. If a calendar year partner owned a partnership with a January 31st year end, the partnership's income earned from February all the way through December wouldn't flow through to the partner's tax return until the following calendar year.
That partner could defer 11 months of income into an entirely new tax year. The IRS rules are specifically designed to stop this exact kind of tax delay.
Let's shift gears to Section 4, operating and reporting.
When it's time to report to the IRS, the partnership first calculates its ordinary business income or loss from making and selling sheets. But then you have these specific items, known as separately stated items, that must be pulled out of that main calculation. Why? Because things like dividend income, capital gains, or guaranteed payments to a partner affect each person's personal tax situation differently. If a partnership just lazily lumped dividend income into its ordinary business loss, a partner wouldn't be able to utilize their special, lower individual tax rates for qualified dividends. To report all this, the partnership files Form 1065. And right here on page 1 of the return, you can see the overall ordinary business calculation. For their 2024 tax year, after subtracting cost of goods sold, wages, and depreciation from their sales, Color Comfort Sheets generated an ordinary business loss of $60,800. Notice that those separately stated items we just talked about are completely absent from this specific page.
That brings us to Schedule K, which you'll find on page 4 of the 1065. This schedule summarizes the flow-through items for the entire partnership. Here you'll see that $60,800 ordinary loss up top, for sure, but you'll also see a $10,000 guaranteed payment for services, $500 in dividends, and $300 in long-term capital gains. Schedule K ensures these special items aren't just buried in the operating loss, perfectly preserving their unique tax character.
Finally, the partnership takes those totals from Schedule K, slices them up, and generates a Schedule K1 for every individual owner. This one is for Sarah. It details her precise 40% share. She receives a K1 showing her $24,320 share of the ordinary business loss, her $10,000 guaranteed payment, and her share of the dividends and capital gains. Sarah will literally take these exact numbers and plug them directly into her personal 1040 tax return.
Which brings us to Section 5, adjusting your tax basis.
Listen, if you don't adjust your basis, you will either get double taxed or you'll illegally deduct losses you aren't entitled to. The IRS loves its rules, so we have to adjust Sarah's basis annually in a very specific order. We start with her beginning basis of $152,000. First, we increase it for her share of income items and any new partnership liabilities, adding $12,320. Next, we decrease it for a $10,000 cash distribution she received. Only then do we finally subtract her share of the operating losses, which is $24,320. This precise sequence lands her at a final year-end basis of $130,000.
And our final stop, Section 6, overcoming loss limitations.
The IRS is extremely wary of tax shelters, so they don't just let you deduct any loss freely. Your loss must successfully clear 3 sequential hurdles. Step 1, you must have enough tax basis. Step 2, even if you have basis, you must have enough at-risk amount, meaning your basis isn't artificially inflated by debt you aren't personally responsible for. Step 3, you must actually materially participate in the business to avoid the passive activity limitation. If your loss fails any of these hurdles, it gets suspended and carried forward to future years. Let's see this in action with Nicole's share of the loss, which was $18,240. First, she hits the tax basis hurdle. Her basis was only high enough to allow $13,240 of that loss, meaning the remaining $5,000 is immediately suspended. But wait, it actually gets worse. Of that $13,240 that cleared the first hurdle, she now faces the at-risk hurdle. Because Nicole wasn't personally on the hook for $9,000 of new non-recourse accounts payable that the LLC took on, that $9,000 gets suspended here. Out of an initial $18,240 loss, Nicole is only allowed to currently deduct $4,240 on her tax return this year. The rest is trapped until she gets more basis and more at-risk investment. It's a massive puzzle, isn't it? We started with the promise of avoiding double taxation, but as the Color Comfort Sheets case study proves, that flow-through advantage requires some rigorous navigation. You have to track every dollar of recourse versus non-recourse debt, properly account for services rendered for capital, and meticulously adjust your basis to ensure your losses aren't trapped behind IRS hurdles. But mastering these structural mechanics is exactly what separates a struggling startup from a thriving, highly tax-efficient business. So I challenge you to look at your own business structures. Are you fully optimizing your tax clock and your basis adjustments? Keep learning, keep optimizing, and we will see you on the next explainer.